Alright, so today's bank is WesBanco Incorporated. It's in Wheeling, West Virginia. Ticker is WSBC. They've also got some preferred shares at WSBCP at 6.75% fixed rate, so those could be of interest as well if you don't want the common shares. But over the past year or so, it looks like the price has, like most banks have over this, looks about the same trajectory, maybe a little bit of an increase over a year. It's an average sized bank, so market cap of about 1.5 billion. They've got 192 branches across West Virginia, Ohio, Pennsylvania, Kentucky. So really diversified across a lot of states and a lot of branches, a lot of different communities. So if we go over to the statistics, we can see a little bit more about how it's priced. It's got about 11 PE, which 1 divided by 11 is about a 9% yield. So 9% is a little on the low end of what the average bank is right now. This price to book is really low, 0.65 right here. But I believe they have a lot of held to maturity securities on their balance sheet, which aren't adjusted down to their fair values. So that could be not necessarily comparing apples to apples with other banks that might not have held to maturity securities. Anyway, so we can dive in a little bit at the price relative to its net assets later on. But as it stands, the profitability, about 0.87% return on assets, 6% return on equity. That's a little bit lower than normal range. So the bank perhaps is not as profitable as some of the other banks in our database, but so let's dive in a little bit deeper. So starting with the balance sheet, so we can see here that they've got some available for sale securities held to maturity. Total securities coming out to about 3.3 billion. That percentage of assets, if we were to add all that together, it was about 19%, almost 19%, which is a little bit higher than most of the banks in our population. So they were a little more weighted towards securities. And if you were to look at calculate the same percentage of assets for the loans, it would be about 67%, and that's a little bit on the low end. So these guys are a little bit more weighted towards securities than loans compared to most banks. We've also got a lot of goodwill here, so it's about 6%. Most of our banks might be 1 or 2%, so these guys are maybe a little more acquisitive than most of the other banks in our population. So we consider the goodwill is basically where they paid a higher price than what the identifiable net assets are of the other bank or companies that they've bought. So the goodwill is not earning interest or any kind of yield or anything, so it's almost kind of a dead asset on their balance sheet. So anyway, so from just looking at the assets, we can already tell that they're a little more heavily weighted toward securities, which maybe yield a little bit less than loans do. And they have a higher amount of goodwill, which isn't yielding anything. So we could almost make a prediction that they're going to be earning a little bit less on interest income than maybe what the average bank is, or at least at the lower end of the range. So if we come down to the liability side of the balance sheet, their non-interest bearing demand deposits are about 25% of the liabilities, which is actually a really high percentage. So that's great. So perhaps their interest expense is going to be a little bit lower than most banks, and we'll look at the income statement shortly. But one of the things that they do have is a really high amount of FHLB borrowings. It's probably 8 or 9% of the liabilities. So FHLB borrowings have a little bit higher interest rate than even the CDs here. So so we could see that they've got a higher percentage of deposits that aren't yielding, but they also have a higher percentage of borrowings that might have a higher interest rates than other types of funding sources. They've also got some trust preferred securities, which are on a variable rate, floating rate, and so as the interest rates have gone up, then these securities are yielding a pretty high amount as well. And that's the 279 million. That's the trust preferred securities, and then the 72.9 is I believe repurchase agreements or Fed funds borrowings, which are more kind of overnight rates. So there's kind of a big risk that these are going to be higher interest rates, interest expense type of thing. They also kind of reprice really quickly. FHLB borrowings do, and as well as the trust preferred securities and the overnight funding sources. So even if these are at lower rates currently, soon they will be at higher rates. So we'll be able to see a little bit of that in income statement, as well as some of the footnotes. But they do have a good quality of having a lower amount of interest-bearing or non-interest-bearing deposits. So maybe that mitigates a little bit of these higher interest rates on the funding sources, and perhaps hopefully might even out a little bit of the allocation in the assets, making lower yields. So another thing to note that we mentioned is they've got some preferred securities here. So those of course take out the earnings from the common shareholders, so we'll see that on the income statement as well. But so coming down to the income statement, we've got the the interest income and dividends, and interest expense and the net interest income, and then non-interest income, non-interest expense. So very normal income statement for a bank. So what we have here is about 167 million on loans, 22 million on securities, 6.4 on other interest income. So that might be on the cash or other investments that they have. But so the total comes to about 195 million of interest income, and that's right around 5%. So that's actually right in the middle of what the average bank might have. The average bank might be somewhere between 4.75 and 5.25, so we're right in the middle. So the allocation to securities and loans perhaps wasn't as bad as what we might have expected. So we're kind of right in the middle of the yields here. And so from an interest expense standpoint, we've got about 60 million on deposits, and then 81 million on the, or not 81 million, a little over 20 million on the debt. So for a total of 81 million of interest expense, and that comes to about 2.18% of assets. So, and that's it's outside of the range. So it's above the range of what we might normally see with a bank. Normally right now somewhere between 1.6 and 2% is what we might see. So maybe we were correct that there's a lot of more expensive funding sources on their balance sheet that are causing them to have a higher interest expense. And so then we've got a provision for loan losses, and so then net interest income of about 114 million before the provision. And that's about a 2.57% of assets. So, and that's a little on the low end. We might expect to see somewhere between 2.8 and 3.2. So this 114 million as a percentage of the assets is really, really low. And so that's about maybe what we might expect from our conversation about the balance sheet structure, and so earning a little bit less on net interest income. And so if we came into non-interest income, they've got about 30 million here. They do a little brokerage services, they do some insurance, they do mortgage banking, so they basically do the whole gambit of what full service banks might provide. So I think that probably gives them a little bit higher net non-interest income than most of the average bank. And so this ends up about 14% of revenue, which definitely is higher. It's our normal bank might be somewhere between 10 and 14. So this being a little over 14% lets us know that they can supplement a little of their lack of non-interest income with a little bit of non-interest income from the ancillary financial services they provide. Getting down into the non-interest expense, they've got about 97 million. That's about 43%. So that is about in the middle of the range of what we might see in an average bank. So the average bank somewhere between 40 and 47, something like that. So 43% here is pretty normal. And that gives us a net income of about a little over 35 million. And taking out 2.5 million on preferred dividends gives us about 33 million left for the common shareholders. And so 33 million is about it's about 8.5% of market cap. So that's basically a yield of 8.5% if we were to buy at the current stock prices. And so that's a little bit low. We might like to see somewhere between 9 and 12% earnings yield, but these guys are about 8.5%. I think if they didn't have these preferred shares, they would end up at least in the bottom end of the range. But that coupled with the higher costing funding sources here, I think are kind of made them have a lower profitability than most banks, and then that makes them have a lower earnings yield as well. So, but we can dive into a little bit of the footnotes and see if that makes sense or why that is. So here we go. So scrolling down past the accounting policies here, we can get a glimpse of how the securities are structured. As is the case for most of these community banks, most of the securities are mortgage-backed securities. They've got a few agencies and munis, but the vast majority of it is mortgage-backed security. And they're sitting at big unrealized losses due to the recent run-up in the interest rates, and they're sort of locked into lower interest rate security. And you can see here the timing of them as well. So you see most of the securities are going to mature longer than 10 years from now. So that's really, really risky as far as especially in this interest rate environment where we're expecting interest rates to either stay elevated like this or go up. These guys are trapped into securities that are at really low interest rates for a really long time. So meanwhile, other banks might have securities that reprice sooner, and they can reinvest those at these higher interest rates. So I think by buying this bank, we're at a disadvantage to other banks. Yep, and so coming a little further, we can get it down to the loan. So if you look at it here, commercial real estate, 6.8 billion. That's a little bit on the high end of what most banks we might see. So and residential real estate is kind of about average. So really, they're really heavily weighted toward real estate, especially commercial real estate. And the construction side is a little bit more than what we might see in the average bank as well. So we could say these guys are really heavily weighted toward real estate, with commercial real estate in particular. So those are some of the risks and rewards that we might find when we see the performance of the loans. They also have the allowance for credit losses here. So this line right here, so as of March 31, 2024, this is the allowance for credit losses, disaggregated by each of the different categories of loans. So they've got 129 million of a reserve here. For loan losses, that's about 1.09% of loans, and that's pretty much it's within the average range of what most banks might have as an allowance. And so we can come down to the investment grades. So they rank them by classified, criticized, past status. So normally we like to see their allowance, usually at least, or reserve for credit losses, to at least equal the classified amount. So for the commercial side, they've got about 102 million of classified loans. And so if we were to add the more consumer side, which they've got separated out down here, 7.3 plus 3.3 plus 0.5. So all in on classified loans comes to about 113 million. So relative to the 129 million reserve, I feel like they're really well capitalized as far as reserve compared to the classified loans. And so we can also see a little bit more too about the past due status, the non-accrual status of the loan. So currently they've got about 45 million of past due loans on their books, and about 33 million of non-accrual loans. So as a percentage of loans, these are actually pretty low compared to most banks. So within their loan portfolio, they've got a pretty a lower credit risk than most banks. And also, from what we talked about, the reserve earlier is I think really conservative compared to classified loans, as well as what is sitting in the non-accrual and the past due loans. So I feel pretty comfortable about the credit risk. And they don't have any derivatives, any cash flow or fair value hedge derivatives. Basically just back-to-back derivatives, interest lock commitments, that sort of thing. So they usually don't look so much or consider much about the back-to-back swaps, because they basically enter into a swap with their customer and then enter into an opposing exact opposite swap with another counterparty, and so those two kind of net themselves out. So it doesn't really have an effect on the income statement. So usually don't pay attention to those too much. For the cash flow or fair value hedge swaps, we do pay attention to it because that affects the interest risk. If they're fixing some interest rates, then that certainly affects what interest income or expense might be going forward. So anyway, going down here a little further, we can get to the fair value measurement section. So we can see the comparison of what the securities and loans are on the balance sheet, what they're recorded at on the balance sheet, and compare that to what's the fair value of those assets and liabilities. And what we find is the held-to-maturity securities is the fair values are about 140 million less than what's on the balance sheet, and also the loans are about 400 million less than what is on the balance sheet. So the liability side is not as pronounced, but we do see kind of a big amount of change here as a result to adjusting to fair values, which actually ends up about 20% of equity, 21% of their equity. So it's not as pronounced as what most banks might be. Most banks would be maybe 30 to 40% of an adjustment down compared to their equity. So these guys, I think, are really well capitalized, so it doesn't affect them as much. Anyway, so if you were to adjust all the assets and liabilities to fair value and compare it to the market cap of the company, it would give you about 1.98 times. So by purchasing the stock at the price that it is today, you're buying 2 times, or your price is twice what the net assets are. So, and that's in a normal range for what most banks are right now. Most banks somewhere between 1.5 and 2.5 of fair value of tangible net assets, and so that's what we got here. You can see we excluded the goodwill from this calculation, so that makes the multiplier a little bit higher. So anyway, 2 times isn't that bad. You'll also see it, a lot of other banks that are acquiring other banks will pay about 2 times the net asset value as well. So, so buying at that amount is not too bad of a price, but it's not a cheap price either. Especially in light of what we were talking about earlier with the earnings yield and the bank maybe not being as profitable as the average bank. So, anyways. Yes, and so I think that kind of covers the footnotes and the financial statements, and we can look a little bit more at the MD&A. As we discussed, there's 192 branches, and they're throughout, Ohio, West Virginia, Kentucky, Indiana, Maryland. So a really diversified geography. So now we're down to the net interest income. We can see a chart here of the yields that they get on the loans and securities and all that stuff, as well as the liability side of the balance sheet. So, as it is, total earning assets about 4.98% is what they're. It's really right in the middle of what most banks will have. We'll see somewhere between 4.8 5.2% for earning assets, so these guys are right in the middle. That's good. And the securities and loans yielding about what the average bank is yielding about right now. So asset side of the balance sheet is pretty much pretty average. And so then coming down to the liability side, we've got 2.98% on the earning liability. And that's a lot higher than what most of the banks will have. Most banks will be somewhere between 2.2, 2.7 right now. So, on the liability side, they're having to pay a lot more interest expense than what the average bank is, and that kind of ties back into what we were talking about earlier when we were looking at the income statement, that some of the funding sources might be a little more expensive. And so that gives them a net interest margin of 2.92%, which is a little bit lower than average bank. Most of the banks in our population about 3.10 to 3.5% net interest margin. So these guys are yielding a little bit less than most of the banks in our population. I think that's what's resulting in they're having a little bit less of less income than most banks. And so then we've got the loans and the past due. We've kind of talked a lot about that. The borrowings, as you can see, 1.1 billion comes from the FHLB, and then they've got some trust preferred securities here and short-term borrowing 72 million here, which was the repurchase agreements and federal funds. And as we talked about, the 1.1 billion has a little bit higher interest rates than CDs or savings accounts and such, and so and of course the trust preferred securities do as well, because they're basically a base plus a spread and floating rate. So those have increased recently to be pretty high rates. Probably somewhere 8-9%, something like that. So certainly the debt side of their balance sheet is expensive to them compared to maybe savings accounts or CDs and that sort of thing. So coming down to the regulatory capital, they've got the ratios here, Tier 1 leverage ratio, common equity Tier 1, so on and so forth. The risk-based ratios come a little bit lower than most other banks. So we could say from a risk-based standpoint, they may not be as well capitalized as other banks. But we did see that a lot of their balance sheet is commercial, or not balance sheet, the loan portfolio is a lot of commercial real estate, which might not be given as favorable of a multiplier for its risk. So that might be what's eating into these ratios to make them a little bit less favorable compared to other banks. But non-regulatory capital ratios end up being in pretty average range. So I'm not concerned about the capital position of the company. Like if you were to convert all of the company's assets and liabilities to fair value, which we did earlier, and then calculate the net assets compared to its assets at a fair value, it ends up being a pretty average range, about 5.8% or so. So we're looking for somewhere between about 5 and 7% there. So we end up it's pretty normal. And also, the balance sheet leverage is about, the assets compared to equity is about 7 times, which is a lot lower than what most banks might be at this time. So I think that, these ratios are more related to the risk of holding commercial real estate loans as opposed to the balance sheet being over leveraged. So I feel pretty comfortable about the capital position. And so, regarding the liquidity of the bank, I think there could be some concerning areas if things were to go south. But if you look at the balance sheet, they don't have a whole lot of cash. They've only got about $500 million of cash, which is about it's about 2% or so. Most banks might see somewhere between 3 and 5%. So they've got a little bit less cash than most banks. They do have some unencumbered securities and loans. But if you were to look at the on-balance sheet liquidity, which is the cash plus unencumbered securities, it's only about 11% of deposits. And that's probably a sufficient amount, but compared to other banks have somewhere between 12 and 17%, or 13 and 18% or so. So these guys having 11% liquid assets compared to deposits makes them be in a less liquid position than most banks, but I don't think it's at all concerning. They also have the ability to borrow from the FHLB and the Federal Reserve, so that would give them an extra about $3 billion, I believe, if they needed it. So I think they've got enough liquidity. It may not be as much as the normal bank, but I think that, combined with the capital position, I think they're okay. So then coming down to a little bit of the market risk, we can see that a lot of their, or if interest rates were to go up, they would make more money. Interest rates were to go down, they would make less money, at least from a net interest income perspective. So that might lead us to believe that they're in a net asset sensitivity position as far as their interest rates go. As we saw earlier, a lot of their securities are really long-term dated, which would present kind of a disadvantage in that regard. But if you look at the call reports, you'll also be able to see, what's the repricing timing of the loans and deposits and debts and such. And it turns out the loans reprice really quickly compared to most banks. Most of the loans reprice within a year. 40% of their loans reprice within a year, and 69% reprice within 5 years. So that's a really quick repricing, at least for the 1 year side. So I feel like that's really comforting from an interest rate risk perspective. If the assets are repricing really quickly, because we know that most of their debts reprice really quickly as well, because they're trust preferred securities, which are at variable rates. The overnight repurchase agreements, which of course reprice overnight, and then FHLB borrowings, the 1.1 billion, also reprice within a year. Most of them do. Actually, I think all of them do. No, about 1 billion reprices within a year, about 100 million reprices 1 to 5 years. So the liability side definitely reprices, within a year really quickly. So it's nice to see that a lot of the assets also reprice, and maybe that's why they didn't have any hedges, because they really don't need to, because they're the way that the term structure of their balance sheet is, it naturally reduces the risk. So I like the interest rate risk here. I feel pretty comfortable with whichever direction interest rates go. The bank's still going to be making money. So that gets us to the end of the thing. To recap, the bank may not be as profitable as most banks, and that's due to the liability side of their balance sheet being having a little bit more expensive funding sources. But from a risk standpoint, I like the position of their interest rate risk. I feel like they're handling that really well. They've got good credit risk. There weren't a whole lot of past dues or non-accruals, and it seemed like that they were really well reserved. I think that from a capital risk standpoint, I think it's maybe not as robust. Their capital's not as robust as what the average bank might be, but I think that's it's not so egregious that you could see that you could expect trouble for them. So I think in the grand scheme of things, they're really well capitalized, and they're really well reserved for any potential loan losses. Their term structure on their interest rates is really well positioned. So the only thing is, I think that the bank could probably be a little bit more profitable. So I'm not going to necessarily give it a buy recommendation, but I would say that if you already have it, hold on to it. I think it's a good bank that may not earn as much as the average bank, but it performs pretty well. So if you have any additional thoughts about the bank or anything, feel free to leave them in the comments, and love to hear them. Thank you.